afternoon, everyone. Thank you for joining us on this lovely Thursday afternoon. We will be starting the webinar shortly. Just to seek your patience in waiting for a couple of minutes to allow more participants to log in, we will be starting in another 3 to 5 minutes' time. Thank you for your patience. Good afternoon, everyone. Thank you for being on time and joining us today to know more about the return on your investment through purchasing a London residential property. Savills Singapore is proud to present this collaboration with Maurice Turner Gardner for this webinar. Let me introduce myself. I am Rachel from the Residential Services team of Savills Singapore. A little introduction to Savills. We are a global real estate company that is listed on the London Stock Exchange, employing over 39,000 people across 60 countries worldwide. Our vast international network allows us as a real estate service provider to offer advisory, management, and transactional services. Stay tuned as I will be sharing on 3 exciting developments in the second half of this webinar. So after purchasing an international residential property, What are the capital taxes that you need to be aware of? Now let me hand off the session to the esteemed experts from MTG to dive into this subject. Sarah and Fiona, please.
Good afternoon, everyone, and thank you, Rachel. Good morning from London. We'd be absolutely delighted to be hosting this webinar with Savills. Morris Turner Gardner is a boutique private client law firm. We were originally the private client department of Allen & Overy until our demerger in 2009. We are based in London, but with a global reach, as we have an extensive network of best friends firms around the world, and also continue to work closely with Allen & Overy. The firm is, however, entirely independent, allowing us to work with the best and most appropriate advisors for our clients. The practice covers tax and estate planning, disputes relating to wealth, real estate, immigration, philanthropy, charities, as well as partnerships and professional practices. I will let Fiona introduce herself to give a quick overview of what the private client team do. Fiona.
Thank you, Sarah. And good afternoon. It is a pleasure to be co-presenting with Savills today. And I just wanted to take a brief moment to introduce myself. I am a partner in Morris Turner Gardner's private wealth team, which means I leave the buying and the selling of properties to Sarah, and I help our clients understand the wider estate planning needs, and in particular, and of relevance today, the fiscal implications of buying, holding and disposing of property in the UK, so you can understand your true return on investment in real estate. I help clients from all over the world with their estate planning, and as both a solicitor and a chartered tax advisor, I advise on not only tax, but also trusts, wills, powers of attorney, and our team can even help with immigration matters. Today, however, I'm only going to focus on the tax implications of owning and disposing of UK residential property. And if we have time, we'll share some of our recent experiences of the immediate impact of COVID-19. I will also give you a quick update, of course, on our Chancellor's announcements last week in connection with stamp duty land tax, which will be of particular interest, I believe. But we'll come on to that in a little while. I'll first hand you back over to Sarah, who's going to give you a property update on real estate in the UK, and particularly prime central London, from a lawyer's perspective. Back to you, Sarah.
Thank you, Fiona. I joined MTG as a partner in 2013 to head the real estate department. My team specialises in acting for ultra high net worth individuals, buying and selling residential property in prime central London as well as in the country. My international investors, particularly from Asia, are generally interested in new build developments, like the ones that Rachel will be talking about later. I thought it was probably worth providing a summary of what we have seen during the last 4 months and then what we're currently seeing now. As you can see, we're still working from home, but hope with the easing we will start getting more of a presence back in the office and that things can slowly start returning to some new form of normality. I was very pessimistic about my practice coming into lockdown, and thought with the closure of all the agencies, no viewings, surveys or bank valuations taking place, that it would fall off a cliff, but it didn't. We were lucky. We had a good pipeline coming into lockdown following the result of the general election in November, and a bit of a Boris bounce helped us after so much uncertainty. So December, January and February were super months for us. Even though the last 4 months have been extremely challenging, we have managed to complete over 30 transactions during lockdown, as well as exchanging on new matters. It's been challenging making sure that all the documents and money are in the right place at the right time, given that not only lawyers are working from home, but also the banks. We have had to create practical solutions and workarounds to facilitate completions, and we've generally done this by incorporating what we call COVID-19 clauses into our contracts, which basically extend the exchange and completion deadlines. These provide in general terms that where there is a delay to completion due to a COVID-related event, there is no default and completion can take place on notice once the event causing the delay is resolved. This should always be subject to a long stop date, which is a date after which, if completion cannot take place, one or both parties may terminate. I have to say we've been very lucky in our practice that I have not had to terminate any of our contracts, and completions have gone through on the completion day. We've also seen a big uptick in people wanting to buy in the country. This has mainly been driven by our domestic buyers wanting an additional home. One of the key questions to ask, however, when buying in the country is, what is the Wi-Fi connection like? Key new build schemes are continuing to attract interest, and we have seen a number of off-plan new builds exchanging during lockdown from our international buyers, as no inspections or viewings of the property is necessary. There is definitely a new build premium that we are seeing, particularly in the outer zones of London, like zones 3 and 4, where there is more open and community space with facilities. We've actually also exchanged contracts where clients have only viewed the property virtually. I was asked whether I've seen many discounts or price chips being agreed during lockdown, and I have to say that we haven't, other than some slight discounts of around 2 to 5%, but Savills are best placed to answer any questions on what their research data has revealed in this respect. So generally, sellers in this market have not been distressed, unlike in 2008, 2009, and therefore, unless offers are sensible, my clients who are selling have decided either to hold off basically until the pandemic is over. The one area of London property market least affected by the lockdown was the supply of rental properties, and Rachel will speak later about the yields the new developments will achieve. Throughout April and May of this year, the number of instructions to rent was consistently ahead of the same period last year, as owners hedged their bets during the pandemic and opted to let rather than sell. So what are we seeing now? Since the easing of the restrictions for estate agents 8 weeks ago, we've seen a lot of pent-up demand from clients who were thinking of buying pre-lockdown. The pent-up demand from buyers and low interest rates are supporting prices, and we understand from the agents that more stock is slowly becoming available. Rightmove reported that at the end of May, over 5.3 people were browsing for property, breaking records for portals since the start of lockdown. We have seen that higher and lower value markets have performed most strongly in London since the lockdown was lifted. Recent research data reveals that the number of offers agreed below 1 million since mid-May was more than 50% higher than the 5-year average for the equivalent period. There will always be a flight to best in class, and we have seen more demand by clients for new builds, family houses and flats with outside space or access to communal gardens or garden squares, or as I said before, in the outer zones of London. Love for open plan seems to have changed a bit, and clients are looking for properties with 2 or more bedrooms so that one can have a study, given we think that working from home is something that we shall see a lot of in the future. Interestingly enough, where clients are getting mortgages, we have not seen any down valuations at the moment by the banks as we had thought. So who is buying and what are they buying and where are they buying? Well, as I've said previously, we've seen a lot of interest in the country or to the outer zones, but we're still seeing a mix of international and domestic buyers. Our international buyers are still buying in London, whereas our domestic buyers, as I've said, are interested in second homes in the country. We're seeing more interest than usual from our Hong Kong market, but also the Asian market is still strong, particularly investors for both resi and commercial properties. London will always remain attractive in my view. Despite the increases to our stamp duty over the past few years, the UK is still cheaper in terms of the transactional acquisition costs than, for instance, Canada, Singapore and Hong Kong. Fiona will come on to this, but as she alluded to, the good news story last week was the change to the SDLT threshold, which is effective immediately and lasts until the 1st of April 2021. Effectively, the nil rate band increases from £125,000 to £500,000 and gives a maximum saving of £15,000. A number of our investor clients will often buy 6 or more properties in one transaction in order to access the commercial SDLT rates, which are 5%. This will not now be necessary during this SDLT holiday, and they will actually save some money. It will come as no surprise that most agents and developers are delighted with the policy, and the news seems to have an instantaneous positive effect on buyer activity. In the first half hour after the announcement, traffic to Rightmove jumped by 22%. So it just really shows you how that sort of infused the market. I will now hand over to Fiona to run through the pertinent UK taxes. Fiona.
Thank you, Sarah. What I'm going to focus on today are the capital taxes that can apply to residential property in the UK. As you can see from the slide, there are, however, a number of taxes to take into account. There's the transactional tax on acquisition, stamp duty, land tax. There's a ownership tax if a property is owned by a company, and that's the annual tax on enveloped dwellings, or ATED for short. Then there is a tax on a disposal, whether that's by gift or by sale, and that's capital gains tax. And of course, our tax on death, which is inheritance tax. Now, there are also other taxes like council tax, which pays for local services in your area and varies depending on what area a property is in. And of course, there's tax on income receipts. So that will either be income tax or corporation tax, depending on who the owner of the property is. But I'm not going to focus on the income side of things today. I'm going to focus on the capital side of things today. And I often find that most of our clients understand the headline rates from these taxes, but to really understand what your total exposure is, it's best to get into the nitty-gritty and understand what the reliefs from some of these taxes are, because wherever there is a tax, there is also a relief or an exemption. So I will come on to SDLT at the end, but I'm going to start with the annual tax on enveloped dwellings. Now, this is a tax that was introduced in 2013 and applies to what the legislation calls non-natural owners. So broadly, companies that own property and residential property only in the UK. Now, there are various reliefs available, and I'll come on to the specific one that we see most often in practice in just a minute. But broadly speaking, this tax will only apply where the property itself is occupied by the shareholder or by a family member of the shareholder, or is not occupied on commercial terms of rental. And so, for example, we see often prime central London main residence properties that can be in the over 10 million, over 20 million pounds for that single property. And in those cases, if it was held by a company, you can see from the table on the right-hand side of the slide that for the highest rate, there could be an annual tax charge of nearly £250,000. So that's quite a hefty amount. And for that reason, we very rarely see corporate owners of owner-occupied property anymore. At the bottom end of the scale, for properties between £500,000 and £1 million, the annual charge is clearly much less, at £3,700. And it's around that sort of value where that may be considered a palatable tax expense if one is not quite sure whether they're going to let a property or use it themselves on a temporary basis. So that's sort of, we see some movement there. The charge is, as the name explains, is an annual charge. You'd be surprised how many times clients ask me how often this tax needs to be paid. It is updated annually in line with the Consumer Prices Index, but the valuation band is set for 5-year periods. So if you bought a property now, you would look at the value now and which band that would fit into, but the set valuation dates need to be reviewed and to see if that value has changed and moved you up or down a band in the interim period. So our next revaluation date is the 1st of April 2022. Now, even if you do qualify for one of the reliefs from this tax, then a tax return still needs to be filed at the end of April. So let's have a quick look at what reliefs are available. I've listed a number of them on the right-hand side of the slide, but the one that I want to draw out today is the one we see most in practice, and that's the property rental business relief. If the conditions for this relief are met, then no annual tax is paid at all, although the tax return is still required, as I've said. And the conditions are that the property must be exploited or intended to be exploited as a source of rents in the course of a qualifying rental business that is carried on by the company. So what does that mean? It means that you are letting the property to a third party on commercial terms, so general buy-to-let scenario, or if the property is laying vacant, you can still qualify for the relief if you are taking steps to let it out in that way. So, for example, that would include employing a letting agent, marketing the property, making sure that repairs are done to the property in readiness for rental. But it's important that this is all being documented so that the company has records should our tax authorities say, well, actually the property was empty, do you really qualify for this relief? The second part of the qualifying criteria for this relief is that it cannot be occupied, the property cannot be occupied by what the legislation calls non-qualifying individuals. So I mentioned shareholder and family members. Those are the non-qualifying family members. So the ultimate owner of the company, spouse of that person, brothers, sisters, and children, grandchildren, and so forth are within that category. Now I'm going to put ATED to a side for a minute, and we're going to move on to capital gains tax. And this is a tax which applies not only on the sale of a property, but also importantly on a gift of the property. And as I mentioned when I introduced myself at the beginning, I help clients with estate planning. So I'm often working with parents who are looking to pass wealth down to the next generation. And one of the things they look at is giving away property in the UK, a rental property, for example. Now, capital gains tax has been around for a long time for UK residents, but for non-UK residents, it's only really been applicable most of the time since April 2015, so it's relatively new. There were also new rules introduced in April last year, which extended the non-resident capital gains tax regime a little bit further. So the April 15 rules only applied to UK residential property. From April 19, they apply to commercial property and also to disposals of shares in companies which own property. Now, it's important to know that there are reliefs, again, for capital gains tax. But before we look at the reliefs, I just want you to note that on the right-hand side of the slide, I've put the current tax rates for capital gains tax for individuals, which are at 18 or 28%, depending on levels of income in the UK. Everyone does get an annual exemption of £12,300, and so and if you are a co-owner, you each get that exemption. But if you are owning in a company, the rate of tax is much lower because it's corporation tax, which is now down to 19%. So let's have a quick look at reliefs from capital gains tax. The main relief that applies is one that is only available to individuals, so not to companies, although companies, of course, do get the lower rate of corporation tax. And it only applies to main residences, so not to investment properties. And it's called a principal residence relief. Now, if one has more than one residence, so a residence in a home country, so a residence in Singapore and a residence in the UK, it is possible to make an election, which is sent into our tax authorities, which lets them know which one the owner is choosing to be their main residence for the purposes of capital gains tax. Now, there are timing restrictions for making that election, and the property does also need to be used as a main residence. So it can't just be a property that's used for a couple of weeks a year. it needs to be, it needs to have the quality of a home. And there's rafts of case law on what those requirements are. And once an election has been made, the final 9 months will always apply. Now, I've listed a couple of the other reliefs on this slide, including lettings relief and absence reliefs. Now, we can come onto those in the Q&A if they're of particular interest to people. I think the takeaway is that they are really only available for limited periods of time, and the property still must have been a principal residence at some point. The point I wanted to come onto, though, which is very specific to non-resident capital gains tax, is that there may be years that you qualify for relief and years that you do not qualify for relief, and those would need to be calculated when looking at the total gain that would be made on a sale or gift of the property. Now, a non-qualifying tax year is one in which both the owner or his or her spouse or civil partner are not resident for tax purposes in the territory where the property is located, so here, and also that the occupancy test is not met. And that occupancy test is basically spending 90 days in the property. So if one of those does apply, then you'd be able to qualify, but otherwise it wouldn't. So as I said, there will be some years which the relief will apply and others which it won't. But importantly, this is not a relief that applies to investment properties or to corporate owners. So let's take a step back now and look at the tax which my clients ask me about the most, and that's inheritance tax. And the reason I'm asked about it the most is because it is the highest of the capital taxes that we have in the UK. And the rate on death is 40%, which is quite large. So often clients will say, well, why will I invest in the UK if 40% of what I own could be taken away should I pass away when still owning the property? Well, every individual receives a nil rate band, so a 0% tax band of £325,000. Everything over and above that on death is taxed at 40%. And there are some lifetime gifts which are subject to inheritance tax, which I know sounds odd because we always think of inheritance tax as only applying on death. But broadly, there'll be gifts to companies that you are not a shareholder of, or gifts to a trust. Gifts between individuals are free of tax provided the person making a gift lives for 7 years from the date of that gift. But we do have some very generous exemptions, very few, but very generous all the same. So we have a spouse exemption and a charity exemption, both of which mean that there is zero tax to pay if leaving assets to a husband or wife or civil partner or to a charity. The former being the more used exemption. Now we understand what the rates are, we'll have a look at what inheritance tax applies to, because that has changed in recent years. And then I'll explain to you some very simple techniques of how to mitigate or manage and minimize that exposure. So inheritance tax will apply to UK situated assets. Now that's been the case for a very long time. And so if you've owned a residential property directly in your own name in the UK, that property will have always been exposed to inheritance tax. Now, because of that, many foreign investors used to buy their properties through a non-UK company, a BVI company, for example. And so the asset that they actually owned was shares in a non-UK asset rather than the property itself. Now, because of the introduction of ATED, that can become quite expensive for some, and so our government changed the rules in 2017 so that now shares in a non-UK company owning residential property in the UK are also subject to inheritance tax. Further, any loans to others used to acquire, maintain, or enhance a UK residential property are also subject to inheritance tax. Now, I see that the most in the estate planning sense, where we're looking at perhaps a parent helping a child get on the property market in the UK, or looking to invest in property in the UK, and they say, well, we'll make you a loan. And not only then will the child buying the property have an asset in the UK, the loan may or may not be deductible depending on a number of factors, but also the loan, the debt owed to the parents, will also be an asset subject to inheritance tax in their hands. So that's important to understand. And furthermore, and this is quite a tricky one for some people, and I'll come on to how we manage this in practice, is that the value of any collateral, security, or asset-backed guarantee for a loan taken, for example, from a bank, to acquire, maintain, or enhance UK residential property is also caught. So it's extended quite considerably in the last few years, but that doesn't mean that that it applies to everybody. As I say, there are ways and means legitimately permitted by our laws which help you to reduce your inheritance tax liability. So let's have a look at a few of those. The 4 simplest techniques in order to manage your exposure to inheritance tax are on the left-hand side of the slide. Now, inheritance tax only applies to the net value of a property at the time of a death. So if you have taken a mortgage from a bank and at the time of acquiring the property, it's not possible to take it later and have the same deduction unless it's for maintenance or enhancement of the property. But if you take a mortgage at the outset to acquire the property, then only the net value will be subject to inheritance tax. So if we take a very simple example of, let's say, a property of £1 million with a mortgage with a loan to value 60%. So you've got 40% of that loan, 400,000 exposed to inheritance tax in the UK. Provided you have no other assets in the UK, you'll have a nil rate band of £325,000. So again, you're just looking at £75,000 exposed to inheritance tax in the UK. But that will be reduced to nothing at all if you're leaving your property to your spouse. And indeed, actually, you're not even eating up or using your nil rate band if you do leave the property to your spouse. And in that example, a spouse not only inherits the property, but they also inherit your unused nil rate band. So on a second death, there's 2 lots of £325,000, so £650,000 at 0%. And not many people appreciate that that is an additional relief at a later stage. Now, another way we help clients manage exposure to inheritance tax is looking at co-ownership. We see this more frequently with perhaps family members or friends who want to co-invest in an investment property in the UK. Now, co-ownership means that not only are you spreading the risk of inheritance tax by having multiple owners, but you're also multiplying the number of nil rate bands, number of £325,000, which are available to reduce tax exposure. And finally, one of the simplest techniques of all is to take life insurance. So you're not just managing the amount of tax which is payable, but you're also planning a pot that will be able to, so the proceeds paid out on death will be able to pay for the tax bill. So those are my top tips on managing exposure. How we do that in practice and how we help clients, I've mentioned my top tips on the right-hand side. So taking a mortgage, we know, helps reduce exposure to inheritance tax, but it's important to always check the fine print in mortgage agreements and credit facility agreements, because as I've mentioned on the previous slide, if there's any additional collateral that's taken, security or personal guarantee that is asset backed, then there'll be additional exposure to inheritance tax in the UK. So we make sure that clients are having very early conversations with their banks to see what their exposure is. Secondly, and again, talking in the estate planning context, if there are loans between individuals or between parents and children, then we make sure that they're documented very clearly. Lenders can find themselves exposed to inheritance tax without any thought or meaning or understanding of it on their behalf. And that's because of the way that the rules are drafted. And if I give an example again in a sort of family planning context, if a father, say, makes a loan to his son to buy an apartment in Paris, that's all good and well. We don't care from a UK point of view. But if the son then goes on to sell that apartment and use the proceeds of sale to buy an apartment in London, then all of a sudden the father finds himself with a tax exposed asset. And so what we do in loan agreements is to make it very clear what the purpose of the loan is for, what it should not be used for, and particular restrictions and requirements of notifying the lender if something changes. Co-ownership agreements are very important. Everybody is very happy to co-invest in a property at the outset, but it's better to manage expectations early on. So we will put in place co-ownership agreements for our clients to dictate when a property can be sold, for example, when somebody can force a sale, when a property might be able to be mortgaged, who is responsible for what if it's not equally shared amongst them, and to whom a property can be left on death, for example. So these are all things that are best set out in advance rather than encountering them down the line with no guidance or rules or agreement on what the outcome should be. And finally, anybody that owns real estate in the UK is very well advised to make a will to govern the succession to their UK property. So those are top tips on inheritance tax. Because we're going to look on, and Rachel's going to talk through some of the off-plan properties that are available at the moment through Savills, I'm just going to pick up on a couple of points very specific to off-plan. Now, I'm often asked by clients what their exposure to taxes are between the period of exchange of contracts and completion, because there can often be quite a long period of time for off-plan properties between exchange and completion dates. So we have to look at what you have on exchange of contracts. And in a legal sense, we call it a shows in action, which is effectively a right to enforce a contract in law. Now, our legislation for inheritance tax and for capital gains tax specifically say that such a shows in action, including for off-plan properties, is a UK residential property interest. And that means that if there is a sale or gift during that period, or there's a death in that period, then capital gains tax or inheritance tax will apply. So it's quite important to understand what your liabilities could be if you decide to make a subsale of the right to complete the contract, or if you, in a family sense, you make your decision to exchange on contracts, but then you decide you're going to complete in the name of somebody else, then you need to understand if there's any liability. Now you'll see that the tax I haven't mentioned is the one that I've put highest on the slide, and that is the ATED, the annual tax on enveloped dwellings. And that's because that doesn't apply in this period between exchange and completion. ATED only applies from completion or from substantial performance of a contract, if that's any earlier. And broadly, that means that completion, but not paper completion. So those are the main points on off-plan properties I wanted to draw out very specifically. Now, I promised I'd give you a quick update on what we've seen as a result of COVID. And the main points that we've encountered for the immediate impact of COVID have tended to be people staying in the UK for a little bit too long and inadvertently finding themselves tax resident here. Now, that has quite an important implication for somebody who's trying to sell their property in the current tax year. because what you do is you move from a non-resident capital gains tax regime to a UK resident capital gains tax regime. And as we saw earlier, the non-resident regime only applies to gains since April 2015. But if you've owned a property for 20 years, you don't have to, and so you don't have to pay tax on the gain prior to April 15. Now, if you tip into UK residence, UK capital gains tax, the gain you'll be taxed on the gain for the entire period. So we've seen that in practice where we're managing now timings on completion of a sale. Other examples we've seen is the loss of an 8ed relief, where a property is owned by a company and has been owned for the purposes of letting, but the shareholder or family members have found themselves in the UK and there's been a vacant property, so they've stayed there for a little period. The helpful news from the revenue is that they appreciate that payment of taxes might be difficult at the moment, and so they're taking a bit of a softer approach, a lighter touch on imposing penalties and interest for missed deadlines. Obviously, if there are reasonable excuses for doing that. Now, in terms of longer term recovery, I will hand back to Sarah in a minute to look at property market recovery. In terms of taxes, this is where I wanted to just highlight the SDLT changes from or announced last week in our Chancellor's summer statement. What, as Sarah has explained, has happened is that there has been an increase in the threshold, the 0% rate, which applies to residential properties. So in normal times and before last Wednesday, we have a sliding scale of SDLT, whereby the first £125,000 of a property is subject to 0% SDLT. The next 125,000, so up to 250,000, is subject to 2% SDLT, and then everything over 250 up to 925,000 is subject to 5% SDLT. Now, there are two other bands of 10% and 12%, and the 12% applies over 1.5 million. But what the Chancellor did was to say, well, not just up to 125, but up to 500,000, there'll be 0% SDLT. Now, that gave everybody an immediate saving of £15,000 if they complete a purchase between last Wednesday and the 1st of April next year. So it's only temporary. Now, it was very nice to be able to tell clients at the end of last week that they have made an immediate saving of £15,000 for those that had already exchanged and had built in this cost to their property acquisition. And that was a very nice thing to be able to do as advisors. Now, I've already forewarned Sarah that come March next year, she's going to be incredibly busy with all of her clients wanting to complete before the deadline of this stamp duty holiday. And more importantly, because this comes to an end from the 1st of April, and also from the 1st of April, foreign investors into UK residential property will be subject to an extra 2% stamp duty, then it's even more acute. The saving is even more acute now because the stamp duty will go up even further in April next year. Now, I can't leave stamp duty without saying I haven't mentioned that the additional 3% surcharge or supplemental charge if you're buying a second property or buy-to-let second property. Now, that applies across the board. That hasn't changed, and so I just wanted to point that out, that it remains the case. I'm going to hand back now to Sarah to wrap up on recovery of the property markets, and then I think we'll have time for some questions. Back to you, Sarah.
Thank you, Fiona. Thank you. Well, just really, really very quickly, as I said previously, there's been so much pent-up demand and, long-term recovery for UK property, absolutely. And we're seeing it now. Normally, July, August, we'd expect to see a big slowdown, but that's not happening at the moment. London is always attractive. And as we all know, sterling is suppressed, lending is cheap, and there's still real term discounts for US dollar denominated buyers. So, I mean, this is the time to buy, taking into account the SDLT savings at the moment. London's always been a safe haven anyway, and still a huge draw for our clients with art and culture and the education that it has. And so, yeah, London's always London, and I think it will not wane at all. So over, I think, now to Rachel.
Thank you very much, Sarah, as well as Fiona. So I would like to touch on the first development, which is Butt Square. Butt Square is located in prime central London, Zone 1, the nearest underground station being Ferryden Station. This immediate proximity to Ferryden Station, which is set to become London's most important transport hub, makes Butt Square one of the best addresses in London. What is unique here at Butt Square is that each characterful building is distinct in personality. Whether it is the glazed brickwork and bronze detailing of Fernwick House, the robust traditional lines of Percival House, or the chamfered windows reveals of the Levitt building, which is featured here in this picture, Butt Square offers a different kind of central London living. So what are the advantages of buying an apartment in Butt Square? First and foremost, the development is completed and ready to move in now. This means for you as the buyer, you are able to save the additional 2% stamp duty fees placed on foreigners, as what Fiona and Sarah has mentioned earlier. As mentioned as well, the convenient location of Butt Square to the future Crossrail Farringdon Station allows for transport timings to be cut almost by half. Not only that, the limited supply of residential apartments in the city undoubtedly will attract many corporate tenants and city renters, some of whom will walk to work. For those of you wondering, the indicative ROI for one beds at Butt Square is an estimate of 3.6 to 3.7%. Of course, yields do improve with discounts on price and any incentives included. Come speak to us after this webinar to find out what attractive incentives we have to offer, or just take a virtual tour into the two of the show units at Butt Square. Now moving on to the second development, we have Grand Union. Grand Union boasts a vibrant canal-side living in the Appleton Strategic Regeneration Area. Located in Zone 3, it is a mere 7 minutes walk to Stonebridge Park Station. So what are the upsides in buying in Grand Union? Grand Union is a Berkeley Homes development. The Berkeley Group builds beautiful and successful places, blending homes, parks, and public realm with great facilities to create fantastic communities where people love to live. Secondly, for a low service charge, residents can benefit from self-contained amenities on site, including a nursery, as well as a health center. All units come with a balcony or terrace, with over 50% having water views. Another positive point to note is that Grand Union is within close proximity to Park Royal, the largest business park in London, which is set to create 65,000 jobs over the next 30 years. Apart from the Park Royal, the generator is located south of the river bend at Grand Union. This is a bespoke multi-story industrial hub, which will provide 135,000 square feet of workspace for a variety of light industrial businesses. Both the Park Royal as well as the generator provides opportunities for a high source of tenant demand. Apart from these aspects, Grand Union is also a mere 15 minutes away from the famous Wembley Arena, a venue delivering world-class entertainment. Now, the return on investment for a one bed at Grand Union translates to roughly 4.2%. Right now, we are in the midst of launching phase 2 after a very successful launch of phase 1. Come speak to us more and we will be happy to share what the available units are. Last but not least, let me share on the newest development that was launched a few weeks ago called the Badine. This is a very hot development that attracted overwhelming responses from buyers internationally. Now let me explain why. The developers of the Badine are Mount Anville, a trusted and respected developer in London for over 30 years, whose developments have won multiple awards. To secure an apartment in the Badine, only requires a 10% deposit. There is also potential capital appreciation and attractive rental yields, with rent growth expected to increase 18% by 2024. The Verdine, although located in Zone 3 of London, it is a mere tube stop away from Zone 1. It takes less than a minute to walk from the development to the main Acton line, which is set to be the new Crossrail station ready just next year. This Crossrail will cut travelling times down to almost half, making commuting much more efficient. Apart from this, the Verdine is also surrounded by 6 other train stations, all within 30 minutes walk from the development. There is also a future HS2 station, which will be 15 minutes away. This allows for travelling to other UK cities, such as Manchester and Birmingham, to become faster, making the connectivity unsurpassable. Besides these few upsides, the Verdine is also located in an established residential area, amongst lush greenery and parklands of West London, that is slated to be one of the last pockets of regeneration. There are multiple good schools nearby, such as the Imperial College, which is one stop away. The Cheswick Business Park, which houses over 100 FTSE companies, is also 10 minutes away, and this undoubtedly provides a good source of tenant demand, both on the corporate level as well as on the student level. The return on investment at the Verdine is very attractive. For 1 bed, we are looking at 4% returns. Speak to our sales consultant now, as phase 1 in the Verdine is almost all sold out. Do not miss this opportunity to reap the highest rewards for your investment. We have now come to the end of our webinar. If you have any questions for our panelists or want to find out more regarding any of the developments I have shared, please type your questions in the Q&A box below now. So we will just start off with a question from Mr. McCoy Tan. He asks, what are the applicable taxes for a foreign investor, and what is the best way to manage the taxes? Maybe Fiona, you would like to take this on?
Yes, I'll take that. I mean, I think we've run through most of them today's session, but for an investor, if we're looking at buy-to-let properties, for example, and this may also answer one of the other questions I think that's come on during the course of the presentation. For an investor of a portfolio, for an investment portfolio of properties, then I still see corporate ownership as a very helpful way of doing that. A, because you've got a lower rate of corporation tax on your rental incomes, but also you should be able to attract the relief for property rental business, so you don't have to have the ATED charge. You'll be looking at a sale of the shares in that company, or individually of the properties themselves when you go on to sell. So if you've got one company owning lots of different investment properties, then you will have a corporation tax of 19% on gains on sales and on rental income. The only reason I would not advocate a company ownership for that is if any of those properties might be used by an owner-occupier at some point. We didn't mention stamp duty land tax for a corporate buyer, but broadly the flat rate of tax for a company buying residential property is 15% across the board, unless one of those reliefs that I mentioned apply, one of the ATED reliefs I mentioned apply. They're mirrored in the stamp duty land tax legislation. The difference being that if you fall outside one of those reliefs for ATED, it's just sort of carved up proportionally in the year. But if you fall out of a relief for stamp duty land tax within 3 years, the revenue will look to claw back the additional amount of tax that you've saved. And you tip from the 15% if you don't attract a relief into the normal banded tax rates if you do attract a relief. I hope that's answered that question.
Sure, thanks, Fiona. So, okay, we have another question. Let's go to the Q&A itself. I think this is one of the questions that I was posed from my client as well. So there's this anonymous attendee who says that she's a British national. Her husband is a Singaporean, and they both live in Singapore in a home that is owned solely in her husband's name. Now, for the purpose of calculating the SDLT, or any of the fact that he owns a house in Singapore, does this mean that her purchase in the UK will count as buying a second home along the same lines? Or would it be considered her first home?
It's a very good question, and it's one that we're asked a lot. For the purposes of the SDLT additional rate for second homes, married couples are looked at as one unit. So I'm afraid it would count as a second home, even if the property in the UK was the first home to be purchased by your client or the anonymous attendee, then it will attract the additional rates. And as inferred in these questions, and just to make it very clear for all viewers, it's not just additional properties owned in the UK, it's additional properties owned in personal names anywhere in the world. Whilst I've got the talking stick, so it was, there were quite a few questions in connection with wills, and so I thought I might just pick up on those if I may.
Sure.
The first of which was, if I have a will in Singapore to leave my assets to my wife, do I still need a will in the UK to shield myself from inheritance tax? The short answer is no. Provided you've got a will that leaves assets to your wife, and that is a valid will in the jurisdiction in which it is made, then that is sufficient. We often have clients who like to have an English will dealing specifically with their estate in the UK, and that is because our probate system means that a will effectively becomes a public document when it goes to the probate court. So some people like to keep the rest of their estate out of it, and so just deal with the UK property. And also, when we have to probate a foreign will, it can often take a longer period of time than if you've just got a standalone English will dealing with property. The second question about wills was, if a BVI company owns a residential property in London, should I write a personal UK will or a BVI will? And that's a very good question. It does ask the question. It does raise the question of what somebody's domicile is. I don't think we've got enough time today to go into sort of domicile as a topic, but if you are if you are UK domiciled, you could have a UK will, and that would be fine, because that would deal with all of your assets all over the world. But if you are from Singapore and have always been from Singapore, and you're in a BVI company, then yes, I would have a BVI will governing the succession to the BVI shares. And can a will established in Singapore, which includes one's UK properties, be valid in matters of UK inheritance tax and taxes, UK taxes? Yes, I think I've sort of answered that already. The only reason why you'd have a different will in the UK is for practical administrative ease. So, okay.
Thank you very much, Fiona. So I have another question from Miss Melanie Ng. She wishes to know about all costs involved in owning an overseas property. So I think maybe allow me to answer that. So apart from stamp duty that a purchaser must pay upon completion of the property, there are also other costs such as ground rent, service charge, agency fee for letting, and various repairs and maintenance costs. So these are all costs for the owner. The ground rent is usually rental paid by the holder of a leasehold property to the freeholder, and is typically between £300 to £500 per annum. The service charge is also equivalent to what we know as maintenance fee in Singapore. So this pays for the maintenance of the facilities as well as concierge services for the development. It ranges from £2 to £9 per annum. So as an illustration, for a 562 square foot one bedder at Bath Square with a service charge of $6.50 per square foot per annum, this will equate to a total service charge of roughly £3,653 per year. So if an owner wants to rent out the property and engage a lettings agency such as us at Savills, our discounted fees, if the apartment is also bought through us, are typically between 13.5% plus VAT of the annual rental income, or approximately 2 months' rent. Lastly, as well, the owner might want to set aside £1,300 per annum for minor repairs, management, or insurance costs. As for the tenant pays for council taxes and utility bills. So I hope this answers your question, Ms. Melanie. And maybe we can go back to some of the questions in the Q&A itself. Fiona, do you think that you have anything else that you might want to answer, or can I just pick out one for you?
Well, let me have a quick scroll down. We've got about 26 questions in total, and I'm afraid we won't be able to get through all of them today. So apologies if I don't pick out your question.
And unfortunately, Fiona, they're all tax-based, so I can't help you out.
No problem at all.
So for the attendees as well, if we do not pick out your question, do not worry. We will take this offline as well and answer your question on a one-to-one basis. So if you actually put in your question anonymously, maybe you would like to leave us your name, as we as hosts are the only ones that can see your question in any case. So do not worry about your privacy, being out there. So Fiona, is there any other questions that you would like to?
Yes, let me run through a couple. So there's a question for non-resident capital gains tax. Is the income band based on income generated in the UK only? So that's a quick and easy one to answer. That's yes.
Sure.
There's one there that asks, does the reduction of SDLT apply to exchange of contracts happening before March 2021 or only applies to completed units? It does only apply to completed units. So you need to, as St. Bart's is a good one to buy, definitely.
Yes, that's right. So amongst the 3 developments that I was sharing earlier, Butt Square is the one that is already completed. So if you as a viewer would want to purchase a unit in Butt Square, you will be able to save the most savings. You will be able to save the stamp duty savings as well as not be faced with the additional foreign stamp duty as well.
Exactly.
There's a longer question from an anonymous attendee, so I'm just going to run through. There are 3 questions in it. So firstly, non-resident capital gains tax, how do you determine the valuation in 2015? Well, our valuation agents will look at the properties and comparative properties at that time so that you can ask somebody to do a retrospective valuation if you don't have one. From your experience, do you see clients owning residential portfolio, 5 or more residential assets under personal name or corporate entity? I see a mixture, but because of the corporation tax rates going down more recently, we've seen, and actually some differences in ability to deduct interest costs, finance costs, and I see it happen more with corporate ownership for multiple rental properties. And the third part of the question is, what are the tax efficient options for individuals who own multiple properties in personal name to transfer those assets under a corporate entity? And would you recommend clients doing this for the purposes of managing inheritance tax? So the easy part to answer is, no, I don't recommend people do it to manage inheritance tax, because the inheritance tax will be the same either way, whether it's through a company or individual ownership. Whether you would transfer, or you can transfer assets to a corporate entity, and there is an incorporation relief from capital gains tax if you are incorporating a rental property business. There can, a quirk in our tax law means though that if it's an individual that owns the properties and incorporates, there isn't a stamp duty land tax relief, so there is SDLT to pay on that transaction. However, if the owners are individuals acting in a partnership, there is an SDLT relief on the way in. Okay.
So I think I have a question here from Ms. Kim. To avoid additional surcharge on the second property, may I buy the property in the name of my child? And what is the minimum age to own a property in UK?
Sarah, do you want to take that one?
Yeah, the minimum age to buy a property in the UK is 18 to be the legal owner of a property. Yes, you can buy the property as long as the child is 18, and that should, I think, not incur the additional 3% SDLT charge.
Okay, thank you very much, Sarah. So I think we are running out of time. So maybe we can answer one more question just before we leave. Okay, and to answer some of the attendees' questions as well, this recording will be presented to you guys after the webinar. So do not worry if you have missed out on a certain part of the recording, or if you would like to go back and view it once again. So we would actually make this link available, so no worries on that. So we have one for Ms. Hak Bin Chua. For the mortgage loan, is there any difference in using a Singapore bank or UK bank in terms of tax treatment for capital gains on inheritance?
For tax treatment, there's no difference.
There's no difference, yes.
No.
Okay. All right. Is there anything else that you think that you might want to answer? But if not, probably.
I think someone asked the question about when should you have a co-ownership agreement put in place?
Yes.
At the time of the purchase, or can it be later? Ideally, at the time when you're all together and you actually make the decision, but it doesn't mean that you can't do it later. But obviously, everyone's got to be in agreement to what you decide to do. So ideally, at the time of the purchase, but you can do it later.
And that was exactly the same question I was going to pick up on, Sarah. So thank you. And my answer was exactly the same as well. I think the negotiation is much, if there needs to be negotiation, it's obviously much easier at the outset. If you find yourself wanting a co-ownership down the line, you've got to, as Sarah says, be in agreement. So it can be trickier, but still achievable.
Okay, thank you very much, ladies. So thank you for coming on and co-hosting this webinar with me today. I'm afraid that we have actually run out of some time. So if there are any other questions that the attendees have, we will pass them on to you guys and get them answered as well. So thank you everyone once again for attending our webinar today. So here at Savills, we thank you for your time and hope to see you again. Thanks, Fiona and Sarah, and bye everyone.
Thank you, Rachel. Thank you, everyone. Thank you. Bye.